Thank you very much all for being here. I'm the moderator. I'm Scott Marcus. I'm a senior fellow at Bruegel, an economics think tank in Brussels. I'm also an engineer, but I'm not going to be saying much today. The intent is to give the speakers the opportunity to tell you what they have to say. We have 6 very skilled and experienced speakers who will be making 5 presentations of about 12 minutes each. If everything works as it should, we should have about a half hour for question and answer from you folks at the end. You can issue questions through the Zoom chat function. Almost all of us have been doing this for close to 2 years now, so I think this will be familiar to all of you. In starting, I'd like to make a brief couple of points, though. What we're trying to cover today, remember the title of the session as a whole, the workshop as a whole, is Insights for a Balanced Regulation, Considering Platform Benefits and Protection Needs. Now, we heard a lot about the need for balance in Augusto Paredes' opening remarks. Increasingly, digital platforms are in the crosshairs of public opinion and of regulators, and they come by a lot of that honestly, unfortunately. We're increasingly cognizant of the many hazards that large platforms pose. There's also a temptation to overlook the enormous benefits that they also generate. Some of the largest digital platforms have an absolutely astronomical market cap. That has bad implications, but it also is a positive result of the fact that they're generating huge value. Some of that value is obvious in metrics like the market cap. A lot of it is less obvious. This is also what Commissioner Giomi asked us to focus on as well in our various discussions. Again, the title includes Considering Platforms' Benefits and Protection Needs. And indeed, in this panel, I think we're going to be looking at both. Different panelists will be putting more focus on the one or the other, but recognizing harms, benefits, and how to address the harms is really central to what we're trying to do today. Now, recall too, this particular panel that you've landed in is about economics, finance, and labor. An awful lot of what we heard in the opening plenary, the quite excellent opening plenary, I should add, a lot of it had to do with media policy and freedom of information, and yet at the same time with avoiding misinformation, disinformation, election manipulation, and more. So those are all important themes. From what I've seen of the speakers today, I think we'll be hearing a little less of that in this panel. We're to focus on economics, finance, and labor. And indeed, we'll be hearing a lot about fintech and other finance aspects, but many other aspects as well. We have, again, a very good mix of speakers for the panel. We have Professor Adam Erik Arvidsson, who's a full professor of sociology and of culture and communications at the University of Federico II in Napoli. We've got Professor Alberto Cossu, who is an assistant professor in the School of Media Communication and Sociology at the University of Leicester. Our third presentation will be jointly given by Nicola Bilotta and Professor Fabrizio Botti, both with the Istituto Affari Internazionali. Then the last two, a little different line, not the professors, people a little closer to application. Professor Carlos Aguilar Paredes, who is a commissioner of the Spanish CNMC, the National Competition Authority, and Andrea Stasi, who is a professor of comparative law at the European University of Rome, but will also be making remarks motivated by his relationship with Google. So we're getting a lot of different perspectives, and that, I think, will give us an opportunity to raise useful and interesting questions. So with that said, by way of introduction, I would like to hand off to Professor Arvidsson. And Professor Arvidsson is going to be talking about the industrious platforms. I'm anxious to hear what industrious platforms are. So with that, Professor Arvidsson, over to you. And by the way, I'm very glad that you finally made it in after a few struggles.
Thank you very much for an invitation. Thank you for having me. I'm just going to present a couple of preliminary ideas, which is sort of a research process research project in the making right now. And it's organized around the idea of the industrious platform economy. Now, this term industrious comes from a previous book that I wrote a couple of years ago, where I tried to make the argument that one of the aspects of the digital economy that's been there basically since the start is its dual nature, in the sense that the digital economy and the platform economy in particular does two things at the same time. On the one hand, it creates huge forms of capital concentration, right? So you get digital giants like Facebook or Meta, as it's called now, or Amazon and Uber and other things like that, which have an enormous amount of capital on their disposition and are able to exercise very, very powerful control over markets, and often also subjugate other types of participants to their market control. And this, of course, has been particularly prevalent during the pandemic and the lockdowns, etc., where we've seen an incredible reinforcement of the market power of these big corporations vis-a-vis smaller stores and smaller activities. That's also an interesting cleavage, by the way, and this is probably a bit of a parenthesis, but it's an interesting cleavage if you go and look at the anti-lockdown, anti-vax protests. The main sort of component of those protests are, at least in Italy, but also in the US, I think, to a large extent, the people who are sort of at the receiving end of this strengthening on the market power of large corporations, and who don't see sort of any good prospects in further digitalization. But on the other hand, of course, also digital media, digital platforms in particular, have furthered also the possibility for the proliferation of a number of small scale, or as I call them, industrious forms of economic activity. Right? And the term industrious is, of course, an old term in the English language, been used for a long time. Max Weber used it to describe the Protestants, etc. But as a scientific term, it's been launched in the 1990s by a number of economic historians who started to talk about an industrious revolution preceding the Industrial Revolution in early modern Europe. So late 17th to 18th century being this period of sort of developing market economy organized around a multitude of small scale, capital poor, labor intensive, entrepreneurial activities. And we're seeing the same thing around also the proliferation of platforms, in the sense that it's pretty well known that platforms like Facebook and Instagram, at least initially, have created new opportunities for small operators, right? So vintage trade, or trading used objects, or small craftspersons, and bottom-up fashion, street fashion, etc., has been immensely empowered by these types of platforms. And also the early times of Amazon and Uber and Deliveroo and other these delivery platforms tended to empower small actors, right? In the early stages of food deliveries, some like 5 years ago, something like that, there was a fairly consistent trend whereby you could see that Deliveroo, Uber Eats, and other things like that were creating new opportunities, particularly for small restaurants, right? Small family restaurants that were able to increase their revenue on the basis of these platforms. And at the same time, of course, we've also seen a number of emerging small-scale activities based on these platforms, like the influencer economy, the whole economy of fashion influencers, music influencers, the economy of crypto investors, which I know Alberto is going to talk more about, as well as a whole series of other small-scale sort of celebrity economies. However, with platforms like Amazon, Instagram, and YouTube, there's also been a sort of a second countervailing tendency at work, which is the tendency of sort of making this platform economy, or this influencer economy, more industrial in character. What do we mean by that? Well, we mean simply that over time, the Instagram influencer economy has tended to assume a structure whereby a small amount of very powerful influencers tend to have disproportionately large command over the market, right? And whereby this type sort of small-scale grassroots activity sort of tends to be replaced by this more sort of top-down structures, right? So similarly in the food economy, while Uber Eats and Deliveroo, etc., tended to further the prospects of small restaurants initially, now it seems to be the other way around. Now with the arrival of ghost kitchens and other things, a number of small-scale operations are being outcompeted by these larger operations, by people who are sort of controlling a number of ghost kitchens and using the platforms to sort of, and also the type of data analytics they can get from the platforms to target the products to needs and to sort of anticipate desire and demand in different ways, and thereby introducing new forms of capital concentration. Airbnb is probably the most prevalent example of this, right? Airbnb started out as ordinary people who rent out their spare rooms, but is now, at least in top destination cities like London, Paris, Milano, etc., to a large extent operated by large-scale landowners who operate several different properties at a time, and who have sort of enacted a process of however, my hypothesis is, or my research question is, that it seems to me that what you could call maybe second-generation platforms, TikTok and Twitch and Clubhouse and other things like that, they seem to have at least a number of algorithmic affordances and other types of predispositions that seem to be furthering a more distributed platform economy. It seems to be sort of going back to these early industrious years of the platform. So that, for example, it seems now that Twitch, for example, and together with TikTok, has realized a new economy of small-scale peer influencers. Quite a lot of people who are providing advice on fitness, personal training, life coaching, other type of consultancy like that, while being paid small sums and earning small sums from this, right? So with there was Twitch, as you know, was hacked recently, and a lot of data, including data on their revenues of their users, were put in the public domain. And if you look at that data, I haven't looked really at it rigorously yet, but it seems like there's a lot of people who earn in the range of a couple of €100 a month, right, from their activities on Twitch, whether this is consulting or personal training, and who are sort of integrating this within other types of life courses that aren't necessarily concentrated on that, right? Maybe they're not full-time Twitch consultants, but they do it on the side. And similarly, the economy of sex work, online sex work, is also seeing similar development, right? Twitch and OnlyFans, etc., realizing a new horde of new people who are sort of doing sex work online, call or video calls, other things like that, doing it on the side, and not identifying as sex workers, so to say, but maybe have other types of professions, and earning sort of fairly modest amounts from doing this, right? And there also seems to be a fairly strong connection between media like TikTok, and the ways in which things like street fashion or music is being rearranged, right? In the sense that these media are opening up for a large multitude of small-scale actors running fairly capital-poor organizations, which are now able to use these as alternative channels for distributing and selling their stuff, right? And also for taking inspiration into how to develop, what to put on T-shirts. the whole world of NFTs and non-fungible tokens is, of course, highly interesting in this sense. Also, it's only just starting now, but it seems to be providing a lot of opportunities for artists and other type of small-scale operators to find markets to capitalize on their activities in ways that weren't really possible before. And of course, then also the crypto economy, which Alberto will talk more about, is of course fundamentally connected to these types of platforms and activities. So I don't really have any conclusions at this point, but what I would want to do, what I want to do in this research project is to sort of try to investigate how the balance between industrious or participatory on the one hand and hierarchical market power on the other hand plays out with the evolution of digital platforms. Right? We know that the first generation platforms, Instagram and Airbnb, Uber, etc., have sort of gone from the promotion of industrious activity to new forms of capital concentration. And now it seems that we have a second generation platforms that seems to bring back this type of industrial structure again. And it remains to see a bit whether there will be new tendencies of capital concentration here, or whether the affordances and the structures of these platforms are such that they tend to be more sort of oriented to participatory and more democratic markets. There might be something to say that, you know, whilst Facebook was made in the US, and as we know, the US is a capitalist country, and one of the features of capitalism is, of course, not free markets, but market control by large actors, right? A lot of people think that capitalism is free markets, but that's actually the other way around. When TikTok is made in China, and as we know, China is a non-capitalist market economy, so maybe there will be some, maybe it's a far-fetched hypothesis, but maybe there's something to say in the assumption that a more Chinese notion of markets and how to structure markets is sort of inscribed in the codes and the affordances of TikTok. Maybe that's just bringing it too far. Who knows? Anyways, this is basically the idea that I was having. So thank you very much, and please bear with me if there's not really any conclusive things to say.
Thank you very much, Professor Arvidsson. I think it will work best if we take questions at the end. As I said, I was figuring on a 30-minute Q&A session, or close to 30 minutes toward the end. Thank you very much for keeping to the time. We may want to explore some of your points about North American versus Chinese models. Some of the regulatory approaches coming out of China right now are really quite interesting, I think, for European observers. But with that, I'd like to move on to our second speaker. And before I do, please, a reminder to everyone, if you're not speaking, please mute. It works better if everybody mutes. You don't suddenly end up showing up as the speaker on the screens, and we also don't hear dogs barking. So I would appreciate it very much. Now, with that said, our next speaker is going to be Professor Alberto Cossu, who is, as I mentioned, an assistant professor at the School of Media, Communication and Sociology at the University of Leicester, also head of a program on digital media and society. He's going to be talking about crypto finance between myth, financial emancipation, and digital cultures. And with that, over to you, Professor Cossu.
All right, hello everyone. I hope you hear me well and you can see my slides and myself as well. So I'd like to thank you very much for this opportunity to speak to such a fantastic panel in this hopefully very impactful conference. And also would like to thank Professor Arvidsson for the comments and the links that he mentioned about the industriousness of platforms and the world of crypto. In fact, there are many fundamental mechanisms that apply in this world. So I will try to keep my timing. And so I've been doing research on this topic for some years now, and I'm right now coming up with some articles on this, and I'm working on some funded research on these topics, in which I've started interviewing people, founders, influencers, and investors as well as gathering digital data. Although today I think that given the topic of the conference, my aim would be to try and show what is the impact, a role on crypto finance and the platform's role in mediating this world, and what people are doing in this imaginary triangle between crypto finance, technological mediation, and of course, that includes the platforms and the societal situation that we have now in mind, which has indeed created a new need, apparently a new desire to invest in such assets. So I will picture a very brief context about what is crypto finance, which is an umbrella term that keeps together a number of activity that relate to investing or integrating crypto, blockchain-based infrastructures in many activities. But for the sake of clarity, today I'm mostly focusing on the relationship that small and retail investors, amateur, non-technical experts are doing on this. So we know that Bitcoin starts couple weeks actually after, not coincidentally, I think, the Lehman Brothers bankruptcy, with this idea that banks were pouring in infinite amount of money, and people started questioning one of these interesting analysis, if people started looking at Bitcoin as it was an alternative, a rival to this infinite pouring of trillions of dollars to solve the economic problems caused by the first crisis. As you know, Bitcoin has a limited amount of units to be, it's deflationary in its design, so to speak. So we are now very, very fast forward. The appeal of having a sphere of economic creation which was separate. So of course, this is inheritor of a culture of the internet that can be traced back to the early 90s, when it was the famous Declaration of Independence from Barlow, which was the Grateful Dead lyricist. Now we are in 2021. There are discrepancies among what are the actual numbers of investors. Some people say 120 millions. Some people say 300 millions investors globally. What we know for sure is that for the UK, one of the few countries for which the Financial Conduct Authority has, I think, reasonably reliable surveys, that we have 2-3 millions of investors in the UK right now on cryptos. It has grown massively during the lockdown. And it's quite interesting, and we'll see later on in my presentation why this particular situation that we're living has triggered such a response, because it tells us something about the economic behavior of these subjects. So as I was saying, now we have a capitalization or market capitalization that, according to different estimates, is placed between 2.6 and 3.8 trillion of dollars. There is this whole discussion, sometimes heated in newspapers and broadcast media as well, whether it's too risky for these millennials to invest with these apps. We have luring apps that have put zero commissions on the trades that are done. And incidentally, also this wave of mainstreamization and everydayization of financial investment has brought, of course, I would say so far, little regulatory attention. I think now what we're seeing is that in most cases, they want to stifle the prospect of growth of the industry, according to many reports and many interviews that have been following from the different regulatory authorities on finance globally. So we have these amateur investors, no previous knowledge of finance, and they are socialized to technical and cultural aspects of investing in cryptocurrencies exclusively or mostly on the internet. I think these are very important aspects. So we have, as the internet fosters the creation of such communities, communities of traders of these currencies who use social media platforms to engage in communicative practices that determine and stabilize the value of the coins that they trade. The usual suspects are these generational males, average, so at least this is the mimetic understanding, with a certain degree of factionalism. You can imagine this as the crowds of Reddit or similar forums on the internet. The unusual suspect, however, it is much more interesting, because from this picture from the US, we see a fundamental change in the constituency. We have lesser gender segregation. we have more dispersed adoption, not only white, male, rich, right, living in global cities, and the income levels are very, very varied as well. So we have people investing below the average income on the UK, which is roughly 20,000. And this is one of the main risks associated. So it is interesting that in the situation of crisis, people who are under the median income in a country are actually investing in a highly speculative asset. And I think it's very, very interesting. So is history repeating, we might ask. This is an excerpt from Max Weber article on the stock exchange in the late 19th century, in which it was basically saying that amateurs should be banned from the restricted places where stock traders used to trade, because they seem that it's easy gains, but actually there's much more than that. Okay, so now we might have, we are witnessing, probably, possibly, it's interesting to speculate on this at least, a new wave of financial players who are, I think, rewriting the DNA of finance. Not only, of course, the investors, but the founders themselves, who are sort of aliens to the traditional financial system. All right, so the main insight that I want to share with you is that I think platforms are the key mediators of crypto finance. What you see here is a network of the YouTube channels that actually engage in the popularization of Bitcoin, Ethereum, and cryptocurrency investing. And they provide technical investment, and they provide also to a socialization to the fundamental alternative values that people should embody against traditional finance, to be wealthy, to be free, to be more independent. This is more or less the rhetorical narrative. So what happens here is that these crowds of millions of investors, they are creating a new alternative financial literacy. And they are socialized to a new ethos, as I was saying, this crypto for the people that we could sum it up with. However, even if it's profit-oriented, even if it's speculative, and we might ask, to what extent is it different from the traditional financial system that they are criticizing? They put together a sort of huge Wikipedia of finance that is an infrastructure, a sort of efficient infrastructure of meaning, value, and knowledge. And in fact, in one recent paper that I wrote, I say that probably we could understand this as a sort of capitalist cultural common, might be also a good identification. The platforms, however, they're not only bringing us this possibility of cultural creation, but they are creating problems, huge problems. In fact, we are going from the decentralization, which is the central promise of blockchain and the underlying infrastructure of these cryptocurrencies, from anonymity to pseudonymity to now actual surveillance, because most of the people who buy and invest and engage with crypto do it with centralized exchanges, crypto.com, main apps who require extensive data gathering and identification, might be also a good thing from the regulatory framework, but as fundamentally betrayed one of the central tenets of this promise of emancipation. We have a context in which there is a huge appification of financial investing, which also results into an appeal to emotions and to now problems, clinical problems that relate to addiction to the notifications. As we know, they tend to be like that. So there is a constant data production, which is both explicit and implicit. Implicit because, as we know from datafication, our behavior is constantly translated into quantified data points, but also explicit. People talk and accumulate data about these currencies, and the users who invest, they exploit these same data for their own investments. So it's a spiral that somehow might be also empowering, I might say. Going to economic behavior, this is almost my last slide. We are seeing that probably this wave of massive investment in cryptocurrencies is possibly something to solve existential and financial issues. As the case of Korea, there's a beautiful paper that examines how Korean people were actually trading at 40% of premium Bitcoin because of the crisis of 1997. They were turned into financial subjects, extremely financialized subjects. And it's not coincidence the Squid Game with 300 million viewers, incidentally the same number of crypto investors, according to some estimates, is something that depicts a gambling society, ultimately, of people who are indebted and they literally gamble their own lives. So ultimately, we might want to ask, is irrationality the new source of value? These people seem to embrace a sort of magical capitalism framework in which they express clear skepticism over calculative rationality. And in fact, they prefer the technical analysis in finance to fundamental analysis. And sometimes in my interviews, I gathered that many people think that gambling is the most consistent strategy for gains. And so gambling overall also means that the value of crypto is based on a bet that these people are doing on the collapse of the current social system. Anyway, I think there is a growing difficulty in understanding where this value comes from. And I think that one of the most important venues to explore is the new social foundations of value. There's been science and technology studies, Michel Callon, for example, who have studied the performativity of markets and the rationality of markets, for example, and the role of lay people in these infrastructures. Just to conclude, I think one chart is quite telling on the left. This is from the Financial Conduct Authority, and it's my last slide. Most people investing in crypto in the last year in the UK have had 100% more of gains. But on the other hand, it's interesting that 15% of people are at risk when investing, because 10-15% of people have a very low income. They believe that investing in cryptocurrencies is protected from government, and some people use borrowing to use cryptocurrencies. And to conclude, they are unable to identify, so they don't really know what they're talking about. So I think there's a huge deal to tackle here in terms of risk and customer protection, for example. I thank you very much for your attention, and apologies for running probably a couple of minutes over. Thank you very much.
Thank you very much, Professor Kosu. Only 2 minutes. I didn't feel the need to rein you in. So thank you. That was absolutely fascinating. I appreciate that very much. Well, our next talk is going to be about big tech finance and financial inclusion. So continuing on the financial thread here, and Professors Nicola Bilotta and Fabrizio Botti, both with the Istituto Affari Internazionali and also other affiliations. And I guess I leave it to you to split up your time as you see fit, but please keep to 12 minutes. Over to you.
Thank you very much, Scott. And thank you very much to IIC and AGI for this opportunity to participate in this extremely valuable webinar and to share our contribution with such a distinguished panel of speakers. Our contribution aims to provide an overview of risks and benefits of big tech role in this current rapid transformation of financial system, with a focus on the potential and also unintended positive effects of big techs in finance, especially on financial inclusion, as you mentioned. With the term big tech, we refer to large companies with established technology platforms and extensive customer networks. We refer essentially to well-known cases such Alibaba, Amazon, or Facebook, Tencent. What is crucial is that their business model rests on enabling direct interaction among a number of users, and data by this interaction is an essential byproduct for them. As you can see from the figures, there are three key features of these big tech business models: data analytics, network externalities, and interwoven activities. The self-reinforcing loop between these three elements generated on big tech online platforms allows the different types of users to interact with each other. And building on these advantages of reinforcing this nexus between data network and activity, some big techs have expanded in the financial sector, in the payments segment, in money management, insurance, lending, of course, and in general in financial services supply. This figures estimated that the flow of big tech credit reached $572 billion in 2019, and this means that big tech credit was at least twice as large as fintech credit in that year. And there's, as you also can see, there's substantial variation across countries, with the sum of fintech and big tech credit flows that is equivalent to almost 6% in Kenya, 2% in China, 1.1% in Indonesia. Other major markets like the United States, Japan, Korea, and the UK, fintech and big tech lending flows of less than 1% of the total stock of credit. Even if the growth trends, it's interesting. Discussed distinctive feature of big tech business model shows at the same time, on the one hand, that they are sources of direct and unintended benefits for users and the economy. And on the other hand, they can be a determinant of new risk factors for the financial system. Let me start from potential benefits, because improvement of financial access and inclusion are possibly the most remarkable and challenging outcomes of big tech expansion in financial markets and corresponding innovation. Big tech digital tools that provide individuals, households, and especially small businesses the ability to assess and understand their spending and savings patterns, can improve their ability to manage their finance and identify the most relevant sources of credit and increase their savings rate. This is really important because, according to available evidence, access to savings accounts not only improve savings accumulation, but also impact on households' allocation of spending to, for example, education or healthier consumption. Big tech induced digitalization also provides users with financial services competitive tools across various vendors in order to enhance their ability to meet their specific needs. On the credit side, big tech platforms hold the potential for more unbiased credit decision, as they have access, as said, to large amounts of data and models to assess credit risk based on this alternative data, all the potential to increase credit access for households or small firms that do not have collateral or other ways of securing the repayment of loans that are requested by banks and lenders in general. Early evidence so far from several countries shows that the move to cashless payment system had a positive impact on the well-being of individuals in different ways, by lowering costs, strengthening the ties to other complementary financial services. But big tech innovation in the financial system could also present challenges that will need to be addressed to ensure that the potential benefits are actually attained and risks are well managed. New models of credit assessment based on algorithm and externally data, as just said, may lead to discriminatory decision because they are trained on past data and may have reflected this biased decisions. And moreover, with more data available, there's the risk that data correlated with race or gender, for example, without bias decision could be used, I mean, in a discriminatory or biased way. Big tech ability to produce and control that also makes it harder for other firms to enter the market, fostering concentration and making it harder for competitive dynamics to work. I'll pass the mic to my colleague and co-author Nicola Bilotti for some more reflection and above all specific examples in our framework.
Thank you very much, Fabrizio. Fantastic. So I'm gonna be very briefly, but Scott, if we are going too long, please feel free to interrupt me. So basically, what I wanna illustrate in these few minutes I have, there are just like some concrete examples of what we are talking about. In 2018, we carried out a study on big tech finance, and we conclude that there are 3 mega trends which are the big tech finance is going to be in competition with incumbent financial institutions. So there's offering and providing financial services and products in competition with financial institutions. However, they are also offering products in partnership with incumbents. And the third mega trend is that big techs are also providers of digital products and service to incumbent banks. So when we think about these 3 mega trends in terms of financial inclusion, I'm going to give you some scale of this phenomenon. So first of all, as you see, it's something that is going around in different countries in a different scale. Of course, in China, when we think about loans to SMEs, which are normally an unserved niche of the market, my bank, which is the Bank of Ant Financial, which is part of Alibaba, so the biggest e-commerce retailer in China, they're able to allocate almost these data are taken from the annual reports of these banks, and we are mapping these banks, so the different years of comparison are based on the latest data we have analyzed so far. So as you see, we can see an increase of loans volume in each country. And interestingly, what we can see is that many of these lending activities are related to e-commerce giants. For example, Mercado Pago, which is part of Mercado Libre, which is a sort of Amazon in Latin America. Rakuten Bank is connected and linked with the Rakuten ecosystem, which is the Amazon in Japan. But we also have other interesting cases like Bank Jago in Indonesia, which is a bank owned by the ride-hailing and payments company called Joyak, and also by the e-commerce company called Tokopedia. So why these companies are firstly borrowing money to SMEs? Just because, as Fabrizio already mentioned, they can have some competitive advantages in terms of cross-data analytics and moral hazard mitigation. For example, if you don't repay me the loans I'm giving you, I'm going to kick you out from my e-commerce store. And once you have such a large share of the market, you as a merchant don't want to get kicked off from the store. So you're actually, and then you can reduce the asymmetry information that you have when you are borrowing money. Once they start with target of specific group of users, for example, like sellers on the e-commerce platform, then this big tech tends to expand their credit offering, especially in partnership with financial institutions, with incumbent banks. We have our colleague from Google, and Google has done some great work and very interesting work, for example, in India, where they have partnered with 5 of the biggest Indian banks to deliver instant loans through Google Pay, or when they partnered with Small Industries Development Bank of India to launch a 15 million financial assistance program to deliver microcredit to an enterprise. Of course, one of the key functions of big tech finance has been providing mobile payments, enabling mobile payments. And here we've seen some interesting work in different parts of the world. Of course, one of the, let's say, most well-known cases is China, where Alipay, that is part of Ant Financial, that is part of Alibaba, and we pay, which is part of WeChat, which is part of Tencent, have been a great work in driving financial inclusion through the offer of mobile payment solution. But we have seen the same in India, for example, where when the India government has launched a campaign to foster financial inclusion through mobile payment apps. And here we've seen WhatsApp payments, PhonePe, and Google Pay, which are playing a key role in this frame. And it's very interesting because in India, the government has to implement a 30% cap on the total volume of mobile transaction because they didn't want to, let's say, foster a monopolistic power or role of one or two or three key providers. But we have seen the same in Latin America with Mercado Pago, for example, or also with WhatsApp payment in Brazil. And finally, I want to highlight two key messages here. So the first one is that when we think about big tech finance and let's say their business model, we need to think about the digital ecosystem. So the idea of providing a different range of products and services so that the consumer stay in the ecosystem and he can more or less find anything he needs in the same ecosystem. And this is something that we have observed also in the finance field, where Rakuten and Financial Tencent are also offering a very rich range of products, from payment to loans to insurance to wealth management. For example, Ant Financial had, as for a few years before, the Chinese regulators start taking out their business model, one of the largest, actually the largest money market fund, Yuebao, which was based on average investments of around $600, so a very small average investments. But because the scale they can reach is so huge, the number we're talking about are incredibly high. And the last point I want to highlight is that the ability of big tech finance to offer tailored products in specific jurisdiction. One of my favorite examples is Amazon Rechargeable, which is a partnership between Amazon and Grupo Financiero Banorte in Mexico, where they are offering a prepaid credit card. Yes, I'm gonna let you know. It's a very interesting case because you can recharge by cash your credit card in kiosk, and you can pay online. I'm gonna stop here, and thank you very much for your attention.
Thank you very much for that. This was really interesting. I'll want to hear more from you later, I think, but let's hand off to the next speaker. Before I do, I'd like to remind the audience, we're taking questions in the chat. I'm not really seeing questions yet, but as we're coming to the next to last speaker, I would appreciate if you start thinking about what you're going to want to ask, and feel free to start posting now. So our next speaker is going to be Professor Carlos Paredes, who's a commissioner at the CNMC, the Spanish Competition Authority. He's going to be talking a lot about really what we can do to try to accentuate the positive, so to speak, with platforms and eliminate the negative. There's an old American song to that effect. So with that, over to you, Dr. Aguilar.
Yes, thank you very much for the floor, Mr. Scott Marcus. And let me start just thanking IIC, AGCOM, and the Commissioner Lisa Guomi for inviting me to participate in the webinar about these insights of balanced regulation, considering platform benefits and protection needs. And let me please start with a disclaimer, because I will express some opinions that are not really blending or expressing necessarily the position of the CNMC, where I am right now, Commissioner. And on second place, let me say that it's very difficult to talk after the amazing speech of Professor Tambini, who has made, I mean, all my job before I did. No, anyway, I will try to do my best. Professor Addison, Professor Cuso, Professor Vitola and Botti, and I'm sure that later Professor Stasi are completing and across exploring examples how, under the shadow of the digital economy, our new concepts are born, and concepts which go beyond what the most of us call not imagine with the growing of the burning of platforms. I will try to focus my intervention around one central element, and that's it. How can regulatory bodies carry out with this work in this dynamic, and let me say, and so unpredictable environment? Or this panel, when I read it, this looks funny to me because it is stemmed from the conviction that any regulation of the digital environment must be proportionate, able to balance fundamental rights and freedom without affecting the technological development and economic growth platforms. Really, unfortunately, this premise is a goal to be achieved more than a reality nowadays. No. Then the question from the regulatory board's point of view is, obviously for societies, what is the balance that we are looking for? And what is the real meaning of proportionate in this complex context? An excess of regulation is obvious that can be a barrier for the new business development. The imposition of excessively burdensome requirements for business model based on digital economy can make it impossible to dedicate the few and valuable resources to their development at the key moments in the primary stage of a new initiative, especially in a context where the markets try to be global, but the requirements could be national by different regulators, and that impose local conditions. But on the other hand, the absence of any regulation is with great probability a future source of conflict because it supposes a scenario of insecurity due to the ignorance of the effects that regulation that you will surely appear at some moment will have on these new economy models. Then we have seen along this seminar that we are exploring benefits and also threats that are not derived directly from those proposals for which platforms were initially conceived. That makes the task of regulator even more difficult because it's already difficult to establish a set of common rules for, let me see, the game of the platforms, but try to establish a regulatory framework that encourages the development of all future derivative business is, let me say, an exercise on blending silence. An exercise for the regulatory function imbalance, where sometimes in my position, I have the sensation to fly blind because it's almost an impossible task most times. But here we are, no? Here we are, and then we need to do two different things. The first one is just to prepare a regulatory framework, and the second one is supervise in the best way possible the protection of the common interest. No, this should be the idea. Then the regulatory needs for these unexpected new actors must learn from the threats inherent to the current ecosystem. That's derived from the relatively short but intense experience that we have accurately linked to the behavior of the platform in the market in the last years. As all you know, and Professor Tambani said, European Union response to the challenges exposed by digital platform are two key specifics of legislation, the Digital Markets Act and the Digital Service Act. Digital Markets Act proposal is concerned with economic imbalance, unfair business practice and gatekeepers, and the negative consequence such as weakened contestability of platform makers. The DSA is a more horizontal initiative focused on issues such as liability of online intermediaries for third-party content, safety of the users online, or asymmetric due diligence obligations for different providers of information society service, depending on the nature of the societal risks which service represent. Obviously, as you probably know, DSA is a modernization of the e-commerce directive adopted in 2000. Many years have gone, but the business model on the internet are not only totalmente different of those in place 20 years ago, but also, as I said before, constantly evolving. That is the way European Union needs a comprehensive set of rules to help citizens, companies, and authorities cope with the difficulties, deficiencies, and side effects that the digital revolution has brought about. Deficiencies that in any instance seems to be less abundant than the benefits that the e-commerce directive has enabled. That said, the proposed regulation seeks to ensure the best conditions for the provision of digital services in Europe and to better protect consumers and the fundamental rights online, and to guarantee that companies operating in the European Union can compete freely and fairly. To achieve these objectives, DSA put in place an horizontal and harmonized framework directly applicable to all online intermediary services, including online content platform marketplaces and marketplaces providing services across the whole European Union. This framework establishes a set of proportionate obligations, transparency, and accountability rules. The obligations of the online players will depend on the role, size, and impact in this online ecosystem. A separate tier of obligation will apply to a very large online platform, as Professor Tambani said before. Without going on the details, the measures will improve the mechanisms for the removal of illegal content, with further empower users with more transparency and better reporting system. It's obvious that DSA will have a high impact on media and the media ecosystem, because it sets the future framework to regulate online content and to protect users' fundamental rights, but also because it will be complemented by the existing sectorial regulation. We can understand, and Professor Scott said, the DSA approach to gatekeeper platforms with its self-assessment of threats to fundamental freedoms, mitigation measures, and periodic reporting as an essentiality co-regulatory scheme. So, due to the complexity of the task and the limitations of the current regulatory framework, it seemed consistent to implement a framework with an ex-ante regulation piece that is trying to complement the current regulatory framework. On my point of view, this part should be oriented to establish a fair and clear rule set to prevent as much as it can future infringement. There is another new instrument more related to DSA that it can be understood and kind and expose, because it is looking for simplify and unify the application of the normative, especially beyond national borders, remaining as an additional instrument with the less overlaps possible with the sectorial normative in order to not create legal insecurity. That this is one of the major problems we face when we are trying to create new regulation norms. For this reason, the proposal of the two directives appears as a part of the solution of this regulatory issue. But, and this is strongly my opinion, this approach will hardly be successful without the self-assessment exercise that the new operator must carry out. The final regulatory scheme should include a set of preview rules necessarily clear, but singularity lacks and adaptable if we want that could be useful for the unexpected future. As without them, and the pure supervisory task led to repeating the current scheme. In the general framework, it's essential that the first to participate in regulatory were the companies themselves. And that is because in this first stage of supervision process, it needs to carry out a regulatory safe assessment. Given the dynamic nature of the platform economy, there are so many uncertainties, and any rigid regulatory framework appears inconsistent. And although it may be ironic, the enterprise that will act outside the preconceived frameworks turn out the most appropriate to evaluate their accuracy to the general regulatory principles. But it should not lead the supervisory authorities to inaction. On the contrary, regulation and regulators should take into account the difference in size of the providers to ensure that the excessive burdens are not imposed on smaller operators and new entrants to the market. In our view, from the regulatory side, this approach spurs innovation. Moreover, it's necessary to introduce and apply a sanctionatory regime that guarantees that not compliance with the norm is punished in an effective, proportionate, and dissuasive manner. Our experience as regulators show that it is essential that the regulation establish a specific sanctioning mechanism to guarantee the effectivity application of regulation. Last but not least, is mandatory the introduction of mechanisms to strengthen cooperation between authorities. This issue is of the utmost importance, given that in Europe and around the world, the service around the information society and digital economy are governed by the principle of country of origin, most of them. So we need to improve the best possible cooperation framework between authorities in order to achieve not only the DCA objectives, but for the best protection and empowerment of the citizens in our actual and future global digital economy. So as a kind of first conclusion, and it could be a second order element that appears around this new economy model, is the necessarily new relationship model between regulators and regulate companies. My last consideration. Okay.
You'll need to wrap up, but if it's the last consideration, please give it.
Yes, it's 2 minutes. Sorry, if I can.
Can you keep it to one?
Yeah, I will try. My last consideration is another second order for the regulatory supervision authorities. Is it we need to adapt our procedures because new economy actors operating at technology under a technology base and a high level of complexity, harder beyond that any other regulated actors up to now. Then, if we want to be effective and proactive, as Professor Tamani said, we need to create inside the authority, the regulatory authorities, new divisions able to exercise directly the supervision of all these terms that in primary time must be done by the self platforms. But without these new tools, we will not be able to exercise any control on them. And this control should be as small as possible, absolutely transparent, and must not generate any damage or established to the companies that are operating. If we are able to exercise this function in these terms, maybe we are approaching to the balance that we are desiring and to achieve. Thank you, and sorry for the 2 minutes more.
Well, these were extremely interesting and extremely useful comments. I think that the focus on the need for a new relationship between the regulators and the regulated large firms, the need for new tools and also for new skill sets are things that I heard loud and clear. I think the promise of co-regulatory approaches is also something that I heard. These, I think, are really important messages, and coming from you as an experienced regulatory authority, I think they're especially interesting. Now, with that, I'd like to move on to Andrea Stasi, who is, among other things, the Regulatory Affairs Lead, South Europe and also for academic outreach in Europe at Google, and also a professor of comparative law at the European University of Rome. So with that, over to you, Professor Stasi. And please do try to keep to 12 minutes. I'd like to have a few minutes for questions.
Thanks a lot, our chairman, and thanks a lot to the organizer for inviting me here. In these few minutes, I'm gonna talking about two issues that are related to the benefits of the platforms, as per the title of this event. One is that open platforms can expand consumer choice, economic opportunity, and success for developers. And I'll briefly mention Android and Play as possible examples of that. And the other is that digital maps benefit consumer and businesses, and I'll talk briefly as well about Google Maps. Let me just say one word about how I agree with Commissioner Aguilar on the need of new tools and on specific dialogue between regulators and regulated. So I found his words particularly interesting along with the other speakers, but I think that right now at your level, that's a big opportunity that we could embrace. But on top of that, let me just go back to the key topic of my few remarks here. First, on open platforms, there have been a lot of discussions globally about how mobile ecosystems and app stores operate and the role that good policy plays in ensuring that these platforms provide ample choice and flexibility for developers and users. We have been following this discussion closely, and we do agree that policies in this space should be guided by some fundamental principles that spur innovation, maintain security, and expand user choice. So we think and believe that operating system and app stores should first let consumers download apps and games from anywhere. Operating system should support multiple app stores and allow consumers to get apps and games directly from developers. Second, keep consumers safe by building protections into the core operating system and requiring app stores and developers to follow high safety standards. Third, avoid using non-public data about developers to build competing products and services. Fourth, be upfront with developers about rules, enforce policies in a predictable way, and work with developers to address problems and offer clear means of appeal and redress when issues arise. Fifth, finally, permit developers to build direct customer relationships with reasonable safeguards to protect consumer safety. These principles have roots in our work in the early days of mobile, when we made a bet at the time that a free open source operating system like Android would be good for developers and consumers. There were many different business models. Some charged licensing fees for their operating system, others sold high margin hardware devices. We chose to do things differently by making our operating system and app store free. We also believe, that's the second part of my remarks on open platforms, that operating systems and app stores should have a business model that enables both platforms and developers to succeed financially. Just as it costs money to build an app, it costs money to build a platform, and the platform business model should align its success with developer success. Over the years, we have made significant investment in Android and Google Play, and like any business, we need a business model that lets us keep investing in mobile. Today, Android is used on tens of thousands of device models for smartphone companies around the world, and more than 2 million developers who use Google Play to reach more than 2.5 billion users in 190 countries. We have been able to sustain Android and Google Play. How? Through a fee paid by developers who sell in-app digital content, which is a common model across technology platforms. 97% of developers globally don't sell digital content and are not subject to a service fee. 97%. For developers who do sell digital content, we recognize that one size doesn't fit all, and we have evolved our business based on feedback from our developer ecosystem. And we have tailored our fee structure with a number of programs to meet different businesses' needs. With the new programs we announced this year, 99% of developers globally qualify for a service fee of 15% or less, and developers have welcomed these changes. Thus, we believe that app and game platforms need to balance consumers' expectations of choice and safety, developers' desire to innovate and grow, and their own need for a viable business model. The second part of my remarks is about digital mapping. They benefit consumers, as we all probably know in our personal experience, and businesses. Digital maps help consumers quickly find useful information and help businesses reach more customers, supporting an estimated $1 trillion in annual sales for businesses, according to a consultancy called Alphabet. When searching for something near you, seeing a map is helpful. For this reason, many consumer services integrate digital mapping tools to benefit their customers. Delivery services, as we had before, like Uber Eats, local search like Yelp and TripAdvisor, navigation in-car systems, standalone apps and navigation embedded in other apps, etc. Microsoft, Bing, DuckDuckGo, Facebook, Uber, Snap, all integrate maps into their services using technology from providers including TomTom, here Apple Maps preset as default on iOS, Mapbox, OpenStreetMap, etc. But digital mapping is about more than getting us from A to B, from one point to another. In addition to the simple free maps tools that millions of consumers use every day, there is intense competition in the more sophisticated for-profit mapping space, and billions of investment dollars are flowing to new entrants seeking to meet the demand for digital mapping in emerging technology, such as drones, autonomous vehicles, sustainability, etc. Let me mention the case of Google Maps. Google Maps connects consumers with local and often small businesses, which otherwise would be difficult to find and therefore strongly benefit from the mapping services. People use Google Maps not only to navigate, but also to search for local businesses. And searches on Google Maps for curbside pickup have increased nearly 9,000% year over year in the US. Rival mapping services have many ways to reach consumers as well, and players include Apple Maps, Azure Maps, Bing Maps, Move It, TomTom. Here, technology is the top global location platform for businesses. Move It, acquired by Intel in 2020, has over 865 million users exactly, and offer services in more than 100 countries, and is adding 1.3 million users every day. Uber integrates TomTom's maps, traffic data, and maps API. The regulation, along with this impressive phenomenon, should seek to strike a reasonable balance to leave room for technology that delivers such great benefits to users and European companies. Take Google Search as an example. Google Search has come a long way from the 10 blue links to the feature-rich search experience we get to use today. And in this current experience, the integration of innovative services like Google Maps helps to provide the best and fastest answer to a query related to a location. Maps tells us that users in Brussels airport, for example, or typing the query in Rome airport, typing the query St. Peter's Church, usually want directions. In this case, all roads bring to Rome, not to Brussels. So we show them to the user. And with our own maps, we know whether it contains the high quality information for the user or not. We cannot interrogate all the map services in the world in a fraction of a second and assess their quality for the query we just received. At the same time, we have integrated features like directions, opening times, merchant contact information directly into search. This allows users to find updated hours for a restaurant, takeout and delivery services during COVID restrictions, for example, or safety precautions at the local supermarket, and we can ensure the freshness of this information. On average, local results in search drive more than 4 billion connections for businesses globally every month, including 120 million businesses that don't have a website yet. Rules to limit integration of services like those mentioned earlier, provided in the DMA, for example, in the Digital Markets Act, could prevent companies like Google from building such clearly helpful features with quality of services, integrity, or even security if appropriate safeguards are not provided in the final text. That would have an impact not just on how people use our products, but also on European merchants, restaurants, and services which connect with customers through Google Search every day. In conclusion, this is just an example of a common challenge and a common strong interest we have with all the digital ecosystem and with the regulators. So building the best experience, trust, and welfare for our users. Thanks a lot for your attention.
Thank you very much for those very interesting comments. I got the feeling a few of your comments at the outset were contrasting your business model with those of a different company whose name starts with an A. But with that said, we have just 8 minutes or less to take questions. One that we got from Professor Aguilar is to Professor Cossu, and he asks, do you believe that platforms should supervise the credibility of the information that the crypto community share across platforms as part of their duties? I'd actually like to add a little coda to that question. There was a recent study that claims that 70% of trades of cryptocurrency are actually wash trades, people selling to themselves, presumably in order to boost the value of the cryptocurrency or the status of the marketplace. So with that, over to Professor Cossu. Could you respond to that? Should there be supervision?
Yeah, thank you very much for sharing, first of all, and for adding your comment. Definitely respond. Of course, there is a lot of malfeasance in these networks, and there is a lot of manipulation. And in fact, one of the paradoxes of the financial system, the crypto financial system, is that these public availability of information is used explicitly to manipulate as well. So we know it's probably a phase of the Wild West. There are thousands of cryptocurrencies that will probably be brought down to a couple hundred or maybe less than 100 with regulators. And coming to the question that Commissioner Aguilar kindly posed, is that I think that, yes, platforms should and could embed a system that has to be, I think, on two, takes into account two views. One is that they should reflect authoritatively, because we know platforms know a lot. Google knows a lot. And so using the insights and these powers to say, okay, this is clearly a cluster of, I don't know, criminals or crooks, or getting this kind of insight authoritatively, sharing their insight is one hand. On the other hand, facilitating and making clear what other people think about that. I'm thinking about reviews, but there is a way in which I think trust is to be mediated and remediated by platforms in this way. And apparently this current phase, I think that people, this populist wave of finance, seem to trust irrationally people who are sometimes not worthy of their trust. Funnily enough, and it will be the first time in history, by the way.
Indeed. Well, thank you for that. Let's try to squeeze in one more questions before we get forcibly booted out. Augusto Preta had a question for Professors Bellotti and Botti, and what he's saying is, you seem to say that the fintech platforms can be efficient investing money because they know so much, including they know so much about the user. Do you think this is a good thing or is it a bad thing?
Yes, Scott, thanks. And thanks for the question. Very quickly, I'll try, as we try to highlight, there's a trade-off. I mean, they can be more efficient and potentially, and currently they are somehow, because they can use a large amount of data. And so they can overcome all the problems of asymmetry of information that credit bureau ratings or observational traditional borrowers characteristics banks may find. On the other hand, you can have problem with this credit score models in having biased decision. This lead to what are the policy implications for us, or part of them. I mean, public policy approach need to be more an holistic blending on financial regulation, antitrust policy, and data privacy regulation in order to contrast this possible costs of applying this more data, for example, or other financial risk that we highlighted. Nicola, do you want to add something on that? Because I know you work a lot on banks.
I think we have no time. I would prefer to leave the floor, but yeah, basically you said everything. Of course, as everything, there are benefits and risks. It's a matter of how you regulate them, because of course, they gather different data, which if can be crossed with, like transaction data, could also cause harm. But if properly framed, it could actually empower benefits.
Okay, thank you for that. And while we're on risks and benefits, back actually to Commissioner Aguilar. So you talked about co-regulation. There's also been efforts to deal with misinformation and misleading information through self-regulatory schemes. The advantage of a co-regulatory scheme is that not only are the conditions initially set by the market player, which I think makes a lot of sense because these digital platforms have such different business models, know their risks probably better than the regulator. But in the co-regulatory scheme, rather than leaving the responsibility totally to the platforms, it provides more opportunity for the regulators to step in and monitor the adequacy, which seems to me to be sort of the point of Digital Services Act, with its essentially risk assessment and then periodic reporting on the mitigation measures and how effective they've been. Anyway, what do you think about self-regulation versus co-regulation?
Thank you for the question. No, it's a key point, no, in the implementation of the future DSA, and I mean, and I again say that this is my point of view. It's that the self-regulation should work alone, but in reality, is that or history says that it's much more effective as some kind of co-regulation. I mean that the point is how strong should be this kind of co-regulation. You know, the scan regulation could not be for authorities. The back door just for a continual press for the incumbents or so on. Then I mean that the doing a short, a more approach point of view of the initial question is the line should be in a point between the self-regulation and the co-regulation. And because I mean that it is the ideal point, because authorities need anyway trust in some way that platforms are respecting the previous rules that they know because are in the directives. And then we need to implement some tools, but it's absolutely impossible to scratch around all the platforms searching for infringements. Then we need, that is because it's very important, the relationship with platforms, because they must respond in fair terms when we believe that some kind of infringement is success in there. I don't know if is a good answer, but I mean,
it's a good answer. Well, we're going to lose control in a second. I'd like to take this opportunity to thank these wonderful panelists for some great presentations and thoughtful answers. So with that, here. Well done, everybody.